Welcome to the deep dive. Today, you've handed us quite a stack of sources. We're diving straight into the ever-evolving world of decentralized finance, or DeFi.
That's right. A really fascinating area.
Yeah, definitely. We're going to try and unravel the complex architectures that power these systems, get our heads around leverage in crypto, which, is often misunderstood.
And perpetual swaps, too. A really innovative instrument.
Exactly, perpetual swaps. And then finally, look at how regulators are, grappling with this fast-paced landscape. Our mission today, really just cut through the noise, give you a shortcut to being well-informed, and maybe surface some surprising facts along the way. Okay, let's unpack this.
What's truly fascinating here, I think, is how all these pieces fit together. From the way trades actually get executed to how risk is managed.
Right.
Each component sort of defines this unique DeFi ecosystem.
Yeah.
And we'll be looking at the trade-offs, the innovations, and the critical questions they raise for participants like you.
Okay, first up then, let's talk about the very foundation of trading in DeFi. Decentralized exchanges, DEXs. These are, they're not your traditional stock markets, are they?
Not at all. They're really revolutionizing how digital assets are traded. And we've seen quite a diverse array of designs emerge, each with, unique features and trade-offs.
So where should we start? What's one key design?
Well, let's look at intent-based models.
Yeah.
CowSwap is a good example. Here, instead of placing a direct order, you submit a trade intent.
A trade intent, okay.
Yeah. The system then batches multiple intents together and processes them simultaneously.
Ah, batching. What's the advantage of that?
The big win, really, is reducing what's called minor extractable value, or MEV attacks. Things like front-running, sandwich attacks, essentially ways traders can get manipulated or pay an invisible tax.
Right, I've heard of MEV. So batching helps make pricing fairer.
Exactly. It's designed for fairer pricing. But like most things in DeFi, there are drawbacks.
Okay, what are they? Delayed execution, maybe?
You got it. You might experience delayed execution because the system has to wait to bundle transactions. And critically, these systems often rely on off-chain relayers or solvers.
Off-chain. That sounds potentially centralizing.
It introduces centralization concerns, yeah. And a potential single point of failure. It sort of challenges that core decentralized ethos, but it's often a pragmatic trade-off for, efficiency and fairness.
Interesting trade-off. What about the ones we hear about most often? Automated market makers, AMMs.
Right, AMMs. They operate very differently. Instead of an order book, you trade directly against a liquidity pool.
A pool of assets.
Yeah. So as long as there's liquidity in the pool, trades are always possible. Sounds great, but it comes with its own set of challenges.
Such as?
Well, one big one is capital inefficiency.
Yeah.
AMs need a lot of liquidity to minimize slippage.
Slippage. That's when your trade moves the price against you, right?
So precisely. Especially larger trades. So a lot of capital can just be sitting there, tied up, not being actively used.
Okay, capital inefficiency. What else? I know liquidity providers face risks too.
Absolutely. Impermanent loss is a key risk for them. It's a bit tricky to explain, but essentially.
Yeah, it always sounds complicated.
It kind of is. But think of it like this. If the prices of the assets you pooled diverge significantly from when you put them in, you might end up with less value than if you just held them separately.
So it's an opportunity cost that becomes real if you withdraw at the wrong time?
Exactly. It can become permanent upon withdrawal. And one more thing. AMMs can also be vulnerable to price manipulation within the pool.
Okay. So different models, different problems. Are there others trying different approaches?
Definitely. You have Oracle-based models like Synthetix or GMX. These use external data sources, oracles, like Chainlink, to determine asset prices.
Ah, oracles, for bringing real-world data on-chain.
Right. They're particularly good for assets with less on-chain liquidity or for more, let's say, exotic financial products.
And how do they protect against bad data from those oracles? That seems like a risk point.
Good question. Platforms like GMX actually aggregate prices from multiple sources, both on-chain and off-chain. That helps reduce the risk of oracle manipulation. And they have a matching engine constantly scanning for compatible orders to execute trades efficiently.
Okay. And with all these different DEXs, CowSwap, AMMs, Oracle-based ones, how does a user find the best place to trade?
That's where aggregators come in. Think of 1inch.
Like a search engine for trades.
Pretty much. They route your trade across lots of underlying DEXs to find the best price and liquidity, often splitting the order using smart contracts.
Smart. But I guess their security depends on all those DEXs they connect to.
Exactly. Their security is tied to the underlying DEXs, plus you have the smart contract risk in their own routing logic. It adds another layer.
Okay, that gives us a good picture of the DX landscape. Now, let's shift gears slightly. Let's talk leverage. A powerful tool, maybe even dangerous in the wrong hands, now readily available in DeFi.
Absolutely. Leverage. In DeFi, lending protocols use algorithms for automatic loans, letting users leverage up. The sources define leverage pretty simply as the asset-to-equity ratio.
And how does it work mechanically? Is it like a margin loan?
Sort of, but with DeFi twists. You deposit crypto into a lending pool that's your collateral. Then you borrow against it, based on a loan-to-value or LTV ratio.
Or LTV, right?
Yeah. So for example, on AV2, USDC might have an 80% LTV. Put in $100 of USDC, you can borrow up to $80 worth of something else.
How does this compare to traditional finance, like, say, the repo market? What are the key differences?
Oh, quite a few significant differences. First, DeFi involves pseudonymous counterparties. You don't know who's on the other side, unlike in repo.
Okay, anonymity.
Then, collateral is pooled across all borrowers.
Yeah.
Your claim is on the pool, not specific segregated assets. Also, rates and haircuts that discount on your collateral, if liquidated, are set by algorithms based on pool usage, not negotiated.
Algorithmically set.
Yeah.
Interesting. What else?
Loans are typically perpetual. No fixed maturity, though you can repay any time. Repos are often super short term, even overnight.
Right.
And maybe the biggest difference, automatic liquidation.
Yeah.
If your LTV goes above a certain threshold, bam, your position is automatically liquidated, collateral auctioned off instantly at a discount.
Instant liquidation. Wow, no grace period.
Nope. It's designed to protect the protocol, but it's harsh for the borrower. Very different from the often lengthy traditional processes.
That automatic liquidation sounds like a major deterrent. So, given that, what are people actually doing? Are they leveraging to the max?
You'd think so, maybe, but the data is surprising. The overall leverage of DeFi users typically ranges between 1.4 to 1.9 asset to equity.
Wait, only 1.4 to 1.9? That sounds low, especially compared to what the protocols allow.
Exactly. The LTV implied leverage, what's technically possible, ranges from 3.4 to 4.8. So there's a huge gap.
So what does that tell us? People are being quite conservative?
It seems so. Very conservative, actually. This gap is likely due to, well, fear of that instant liquidation loss, but also what the research calls a search for yield motive.
Search for yield, meaning they're depositing just to earn interest, not necessarily to borrow.
Precisely. They're parking assets for returns, not maximizing borrowing against them. Although, interestingly, the largest, most active users do show higher leverage, often above 2. Maybe they're better equipped to monitor it.
And can you use leverage to go short, too?
Oh, yes. You could be long deposit volatile coins like Bitcoin, borrow stable coins, or short deposit stable coins, borrow volatile coins. And the leverage of those two groups tends to move in opposite directions based on market movements.
Makes sense. What factors push leverage up or down?
Well, higher allowed leverage, LTV implied, lower borrowing costs, and positive market sentiment tend to correlate with higher actual leverage. Conversely, higher collateral volatility and higher returns on just depositing collateral, that search for yield thing again, are associated with lower leverage. People seem less willing to risk borrowing against volatile assets, or if they're already getting good returns just by lending.
And does this higher leverage make the whole system riskier, more prone to liquidations?
It does increase the value at risk, meaning more loans are closer to the liquidation point, so potential stress is higher. But interestingly, it doesn't seem to significantly increase the actual share of liquidations happening. Those are often driven by sudden, sharp market events.
One last point on this. Do people try to game the system when they're close to liquidation, like swapping into riskier collateral?
Most don't, perhaps because the LTV rules are stricter for riskier assets anyway. But the research notes that those who do swap collateral when near liquidation tend to be more aggressive about it if they started with higher leverage.
Fascinating user behavior insights there. Okay, let's move on to something even more complex, perhaps. Perpetual swaps. No expiry date. That sounds different.
Very different. Perpetual swaps, or PERPs, are derivative contracts. But unlike traditional futures, they never expire. They're exclusively cash settled, and you can hold them indefinitely.
But if there's no expiry date, how does the price stay connected to the actual underlying asset's price? Futures converge at expiry, right?
Exactly. That's the magic, or rather the core mechanism. The funding rate.
The funding rate. Okay, what's that?
It's a periodic payment, often every 8 hours, between long and short position holders. Its whole purpose is to keep the PERP contract price tethered to the underlying spot market price.
How does a payment achieve that?
Well, if the PERP trades above the spot price at a premium, longs pay shorts. If it trades below spot at a discount, shorts pay longs.
Ah, so it creates an incentive. If the perp is too expensive, holding along costs you money via the funding rate, pushing you to sell, or incentivizing others to short it.
Precisely. It incentivizes traders to push the price back towards spot. This creates continuous arbitrage opportunities, promoting market efficiency and price discovery. It's a zero-sum game between traders, but it acts like a cost of carry, especially with leverage.
Clever mechanism. Why are DEXs becoming such popular places for these perpetual swaps?
Several reasons. The non-custodial nature is huge. You keep control of your funds, reducing hack risks associated with centralized exchanges.
Right, no counterparty risk like with CEXs potentially going bust.
Exactly. Plus, generally global access without strict KYC, which promotes financial inclusion. And they're efficient, no need to constantly roll over expiring futures contracts.
And that's driving growth.
Explosive growth.
Yeah.
We're talking a 210% year-over-year volume increase for perpetual DX as mentioned in the sources. It signals a real shift towards user control and transparency.
That is massive growth. But you mentioned leverage earlier. I assume perps come with significant leverage too.
Oh, yes. Significant leverage up to 25x, even 50x on some platforms.
Yeah.
Which, of course, magnifies profits, but also, crucially, losses.
So how is that risk managed? Margins and liquidation again?
Yep, you need initial and maintenance margins. And liquidation is that same automated process position, forcibly closed if margin drops too low. It protects the protocol from bad debt.
But couldn't a lot of liquidations happening at once cause a crash? A cascade?
That's the systemic risk. High leverage makes rapid liquidations more likely. If many happen together, forced selling can depress prices further, triggering more liquidations. A liquidation cascade.
Scary stuff. What do DEXs have to prevent that, or at least cushion the blow?
They have insurance funds. These are reserve pools specifically to cover losses when a liquidated position's margin isn't enough, especially in fast-moving markets.
And if the insurance fund runs out?
Then it's last resort. Auto-Deleveraging, ADL. This mechanism automatically reduces the leverage of profitable opposing traders to cover the shortfall, essentially taking some profit from winners to pay for losers' deficits when the system is stressed.
Wow, so profitable traders can actually lose some gains to save the system.
In extreme circumstances, yes. It's controversial, but seen as necessary. And another huge factor is Oracle dependency. Accurate, reliable price feeds are absolutely paramount.
Because if the Oracle price is wrong, liquidations could happen unfairly.
Exactly, or be manipulated. Oracle manipulation is a major vulnerability. DEXs use various techniques like time-weighted average prices, TW, decentralized oracles like Chainlink or Pyth, sometimes dual oracle systems, or even specialized risk oracles like Chaos Labs to dynamically adjust parameters based on perceived risk.
It seems like the underlying architecture really matters here. You mentioned dYdX, GMX. Do they operate differently?
They do, different philosophies. dYdX runs its own blockchain, an on-chain order book built for speed. GMX uses layer 2s and liquidity pools, focusing on aggregated price feeds and capital efficiency. Perpetual Protocol uses a clever virtual AM, or vAMM, for pricing without needing a huge pool of real assets, keeping collateral separate. And Kwenta Synthetix use synthetic assets on layer 2, where S and X stakers act as a collective counterparty, absorbing risk. Very different approaches to scalability and liquidity.
Okay, we've covered a lot of ground DEX architectures, leverage, these complex perpetual swaps. It's clear there's incredible innovation, but also significant risk. Which brings us to the regulators. How are they viewing this rapidly evolving space?
Well, the core principle regulators like IOSCO keep coming back to is same activity, same risk, same regulation. Basically, if it walks like a financial product and quacks like one, it should be regulated like one, regardless of the underlying tech.
Makes sense in principle, but DeFi grew so fast, didn't it?
Explosively. Total value locked, or TVL, hit about $180 billion in late 2021. But then...
And came the crashes.
Yeah. Significant market events dropped TVL dramatically, down to around $47 billion by late 2023.
What events drove that? I remember Terra Luna.
That was a huge one in 2022. Then the FTX insolvency, the USDC depegging scare in 2023. These events really highlighted the hidden interconnectedness within crypto and even links to traditional finance. Lots of investor losses, market disruption.
And is the market getting more concentrated now? Fewer big players?
It appears so. The sources indicate the top 4 DEXs hold about 54% of the market share. Concentration risk is definitely something regulators watch.
Beyond market risk, what about illicit finance? The Wild West perception.
That's a major concern too. DeFi protocols are being used for money laundering and other illicit purposes. One report suggested 57% of stolen crypto funds tracked ended up in DeFi protocols.
Wow, over half.
And North Korean-linked hackers alone reportedly stole $1.1 billion via DeFi exploits. So yes, it's a serious issue.
What makes it so tough for regulators to get a grip on this?
Several things. Data gaps and complexity are huge hurdles. On-chain data is pseudonymous, hard to interpret. Smart contracts can change, their code is complex. It's hard to verify what they really do or represent. There's just no standardization.
And those smart contract audits we hear about, are they reliable?
They're often advertised for assurance, but regulators caution they're voluntary, lack global standards, and might only choke if the code does what it says it does, not if it's fit for purpose or prevents misuse, so not a guarantee of safety.
Okay, so audits aren't a silver bullet. What about market manipulation, like that MEV stuff we discussed earlier?
Market integrity issues are rife. MEV strategies like front-running, back-running, sandwich attacks. One study estimated over $100 million lost just to front-running in about a year.
$100 million. That's not small change.
Not at all. And then there are the risks with oracles and cross-chain bridges, the things connecting DeFi to the outside world. In 2022 alone, reports suggest over $400 million lost in oracle manipulation attacks.
$400 million from bad data feeds.
And cross-chain bridges seem particularly vulnerable. They accounted for 64% of the $3.1 billion stolen from DeFi protocols in 2022. That's almost $2 billion just from bridge exploits.
Those figures are genuinely staggering. So, faced with all this, what are the regulators actually recommending? What's the path forward?
They're aiming to analyze DeFi from multiple angles: the economic reality, the function, the tech. A key focus is identifying responsible persons.
Responsible persons, even in supposedly decentralized projects.
Yes, trying to find who actually exercises control or significant influence, regardless of how it's structured. They also want clear identification and management of conflicts of interest and material risks, especially operational and tech risks.
And better information for users?
Definitely. Demanding accurate, comprehensive, clear disclosures, enforcing existing laws against fraud and market abuse, and crucially, fostering cross-border cooperation because DeFi is global.
It sounds like a huge undertaking.
It is, and it raises that fundamental question: how do you allow this innovation to continue while effectively managing these very real risks to investors and market integrity? It's a very, very delicate balancing act.
Wow. Okay, that was, truly deep dive. We've gone through DEX architectures, the nuances of leverage, the wild mechanics of perpetual swaps, and the huge challenge facing regulators.
Quite the journey through the DeFi landscape.
What really stands out to me is this recurring theme: how design choices meant to create decentralization sometimes loop back to create new vulnerabilities or new points of centralization, like with those off-chain relayers.
Or how tools like leverage and PERPs amplify both gains and systemic risks.
Exactly. It feels like a series of complex trade-offs.
And if we connect that to the bigger picture, it really underscores that while DeFi offers amazing technological potential, the fundamental financial risks don't just disappear. They might even more get amplified.
So the tech is new, but the underlying challenges of finance remain.
Pretty much. The question isn't just if these technologies can work, but how they can be designed, built, and overseen to actually benefit users without just recreating or maybe even worsening the problems of the old system.
So what does this all mean for you listening in? As DeFi keeps evolving at this breakneck speed, really understanding these core mechanics that, how batch auctions work, what funding rates actually do, why oracles are so critical and vulnerable, it empowers you to better judge the opportunities and, importantly, the risks.
It's definitely a space where knowledge is power. Understanding the trade-offs is key.
Right. It's this constant dance between innovation and stability. So here's something for you to mull over. Given the speed of DeFi innovation and that regulatory approach of same activity, same risk, same regulation, what might new proactive strategies look like? How could regulation adapt to truly decentralized, constantly evolving systems without just stifling them? Could we see entirely new regulatory models emerge?
That's the multi-billion-dollar question, isn't it? Bridging that gap effectively.
Definitely something to think about.